For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Good morning and welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name is Jeff Shade and I'm just here to ask the questions. But of course, the words of wisdom and solid advice come from Jake Floyd of Floyd Financial Group. Good morning, Jake. How's the Saturday morning treating you so far, my friend?
Going great, Jeff. Good morning to you too.
Thank you so much. I hope our listeners are doing well today too. Jake, let's get started with what's happening in the news and the economy. Of course, the presidential race continues. It's going to be heating up even more so before too much longer. But I understand that Bitcoin now is having sort of a surge or a rally of sorts, isn't it?
Yeah, so Bitcoin last week reclaimed the all-time high. So it went up above where it was in 2021. There's a lot of people asking me, do we need to jump in on this? And I will say that less people ask me that than, some of the chip stocks that are going crazy right now, because a lot of my clients, by and large, are looking at Bitcoin going, I'm going to pay $69,000 for a what? A Bitcoin? what is that?
Right,
so there's a lot of people that are not really big on that. But I will say that it's a signal that risk-on assets are starting to come back to life after a couple of dismal years. The last little while here has been pretty good for Bitcoin as well as other more risk-on sectors of the market. It'll be interesting to see how it plays out. Usually about the time everybody starts getting excited is when you want to start exiting.
Right.
And we'll talk about that as the show goes on. It's definitely an interesting time in markets given how uncertain things are, yet we're near all-time highs.
Well, Bitcoin exchange-traded funds, they've won SEC approval. That really legitimizes them more so, but I guess not enough for people to put it in their portfolios.
So I think part of the reason Bitcoin is up as high as it is all these ETFs that have been approved on the market have to go out and physically buy Bitcoin in order for them to be able to offer the Bitcoin ETF. And so it's a lot of forced buying. Once that forced buying has kind of ceased, I have a feeling we're going to see it come back down to us at some point. But we'll see. I'm not probably a buyer at this level, but I'm a retirement advisor, an investment advisor, and most of my clients, are 55 or older. And because of that, I'm not looking for return at any risk, right? I want to have good risk-adjusted returns, and Bitcoin is a little rich for my blood up here in the stratosphere.
Well, Bitcoin doesn't seem to be going away. Do you think that it's going to be accepted as much as stocks and bonds anytime in the near future?
That's a good question, Jeff. I think that it probably is more accepted than stocks and bonds among people 30, 35 years old and younger. Mm-hmm. I think most of them grew up with 2008 being their defining monetary moment in their life, and they don't have a lot of trust in the system for good reason, frankly. I think that the chances of baby boomers and older, getting really excited about Bitcoin is probably not going to happen anytime soon.
Let's talk about the Fed cutting interest rates here. Jake, I understand that inflation has been rather stubborn, and now I'm seeing some headlines that doubts are creeping in that the Fed will cut interest rates at all. What's your opinion on that?
Yeah, so I think that sooner or later the Fed will be forced to cut interest rates. The question is whether they want to go out on their terms or whether they want to have a panicked reduction of interest rates back down to zero, coupled with more quantitative easing. Jeff, I still think it's likely we're going to have at least some rate cuts this year. And a lot of that's because we're at such restrictive levels here. And people look around at the stock market and go, what do you mean we're at restricted levels? We're at all-time highs. Bitcoin's at 69,000 or whatever it is today. I think that when we're thinking about the economy, we need to remember that that's different than the stock market or any market, housing market, Bitcoin market, whatever it is. And I think that we need to understand that those two things move independently of one another. And while there are some challenges economically and geopolitically in this country and around the world, those are not necessarily the same thing as the stock market. But when we have interest rates as high as they are, I often say that it's like driving the economy around with the emergency brake on.
Yeah.
Eventually that's going to end poorly. Either you're going to not have an emergency brake anymore, or you're not going to get very far. You have the metal grinding there.
Where are the brakes out? Yeah.
Exactly. So I think that they will be forced to at least come down to a non-restrictive level, maybe around 3% at some point. I still say that this year we're going to have at least some rate cuts. I do think it'll be less than the 7 or 8 rate cuts that were priced into the market at the turn of the year. However, a lot of those have come out already. If I were going to guess, I would say we'll have a June or July 1st rate cut, and then we'll kind of see how it goes from there.
Yeah, and mortgage interest rates are at a 2-month high currently. What do you make of that? What's causing that? And is that of any concern to our listeners, do you think?
I think it is a concern to listeners. I think there's a lot of people that would love to buy a house right now that just can't because they have a 2.5% mortgage, and they'd have to replace it with a 7% mortgage if they went out and bought something. So I think that if interest rates even get down to 4.5 or 5, I think there's going to be a lot of people moving and changing properties. The interest rates being that high is really indicative of just markets in general. And because the stock market's up so much, it's forcing money out of bonds into the stock market, which drives yields higher. I know it's a little bit confusing, but basically the stock market being up and the expectation that the Fed may not cut rates is what's driving interest rates higher in the short term. But I do think that that will come to an end over the next month or two. We'll start to see interest rates slide back down a little bit as we get ready for the first cut.
Our show is called Show Me the Money. We're talking with Jake Floyd here at Floyd Financial Group. We're talking about current events. Let's move on now to chip stocks. I mean, those are pretty popular these days.
Yeah, so I definitely have been getting a lot of emails and phone calls about some of these chip stocks that have been blowing up. If you've been listening to this show for a while, you'll know that I think that an AI revolution is coming, whether we like it or not. It should scare us. However, it's not going to stop some of these Fortune 500 companies from putting trillions of dollars into the system as they build out their AI infrastructure. On the back of that, stocks like NVIDIA, AMD are up huge. NVIDIA's up 600+% over the last 12 to 14 months. It's up 80% this year. But there's some of these stocks, too, that are either suppliers for NVIDIA that have really gotten a huge boost, like Supermicro. So Supermicro was very, very inexpensive stock for a long time and, has traded throughout the 90s and the 2000s and all that. And over the last 3 or 4 years, it's gone from like $20 to $1,050. I've had people calling me and say, hey, do I need to buy this? Just remember that when you see a huge spike like that, it's probably not the right decision to chase it up there because easy come, easy go. As stocks tend to go up really big like that, either you've missed the run or you're jumping in right at the point where people are going to find some selling pressure. We don't want to try to chase these stocks, even though it's a little bit painful to have missed some of the runs, and I understand that. Again, if you are at Floyd Financial Group, just know that we have been and are fairly heavily invested in AI stocks and things like that, so you are definitely getting a piece of this, and if you've been watching your account balance lately, you'll know that. It's important not to chase when things are really hot because that's how you can get hurt.
Yeah, when you hear all the hype about something, I mean, generally the wave is crested there. You need to be on the beginning of that. And NVIDIA is one of those stocks I hear about all the time. But as you said, you want to get ahead of this. You don't want to be at the peak of this. Finally, I want to talk about this battle that's going on between Elon Musk and Jeff Bezos. This is quite a wrestling match these guys are having.
Yeah, and Mr. Bernard Arnault also is in there as far as the top number one, net worth in the world. That the three of them have gone back and forth quite a bit. So Elon, everybody knows who that is. Tesla. Jeff Bezos is the largest shareholder of Amazon stock, and Bernard Arnault is LVMH, which is Louis Vuitton and Hennessy and those companies over there. So they've been going back and forth. But yeah, Jeff Bezos a few days ago kind of reclaimed the title as the number one richest man on earth. I don't think he cares. No. He's actually been liquidating stock recently. He's been in the news the last couple of months for selling several million shares at a time, which is $1 billion plus in some cases. So he's been funding philanthropic endeavors as well as spending a little money on himself too, I'm sure.
What does $100 million mean in terms of what I'm able to buy when it comes to Jeff Bezos? And for that matter, I hear about professional athletes with, this guy got $120 million. I want $150 million. What difference is that really going to make? Is it really just bragging rights?
What's $100 million between friends, Jeff?
Yeah, exactly.
That's something I've given some thought to, actually. Let's say you have $100 million and you make another $100 million. Does that really change anything in your life?
No.
I think once you hit a certain level, there's an expectation or a feeling of need to keep pushing it to get more money, more everything. These people have so much money, Jeff Bezos and these guys, that they could spend the rest of their lives trying to spend that money, especially on anything normal, anything that's not like island buying or building a ship the size of a Carnival cruise ship for personal use.
Yeah.
I don't think these people really watch this or care. He's not sending Elon a text going, ha, 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 or anything like that.
Yeah.
Both of those two. And while I don't agree with Mr. Bezos' politics and all that kind of thing, I think they're focused on the things that are important to them. And that's probably what they should be focused on at this point.
Well, the Beatles had a song, Money Can't Buy You Love, and I have known people who have a lot of money, and they seem to be very, very unhappy with all that money because they don't know what to do with it, and they've realized that money can't buy you happiness. But by the same token, I've known people who don't have a lot, but their happiness, and I think that just goes to show that happiness is not found in a bank account or a financial statement. We're talking with Jake Floyd of Floyd Financial Group. Of course, our program is called Show Me the Money. If you're interested in your money, if you're interested in your financial path towards a successful retirement, I suggest that you call Jake there at Floyd Financial Group, 417-889-7233, and request your no-cost, no-obligation, no-judgment financial review. That's right, it's not going to cost you a dime. It's just a casual conversation, a chance for you to sit down with Jake and Randy when he's in the office, talk about your individual journey towards retirement and the path that you should be taking. Again, no cost, no obligation for this whatsoever, and no judgment. Why don't you make that call this weekend? Leave your name, your telephone number. Ashley will give you a call back during the week next week. Set you up with an appointment with Jake or Randy to talk about your financial future. Once again, that telephone number, 417-889-7233. 417-889-7233. You can also request your plan online at floydfinancialgroup.com. Time for a break, Jake. When we come back, we'll be talking about income sources that the IRS does not tax. All that and more when our show continues right here on 104.1 KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about income sources that the IRS doesn't get their greedy hooks into.
That is a popular topic, Jake. I would imagine that people come to you occasionally and say, Jake, put me into anything that the IRS is not going to tax. Taxation is certainly one of the biggest expenses that we'll have in retirement. The other, I think, of course, is healthcare expenses. We've mentioned that before, but in this segment, I want to talk about some of the investments that the IRS does not tax. The first one is Roth IRA income. Explain that to us a little bit.
Yeah, Jeff, with Roth IRA, when you're funding your employer retirement plans, you can go with either Roth or traditional funding into there. And if you do traditional, that is tax deductible on when you put it in. But when it comes out, it is taxable after you retire and you start taking money out. On a Roth IRA, you do not get the tax benefit when you're putting it in. However, after 5 years and 59 and a half, all of the money comes out of there tax-free, including all the growth. And so, honestly, the Roth is one of the very few things where there's more than just avoiding the tax or deferring it, because you actually do get to permanently not have taxes on the income there. And so I'm kind of surprised, honestly, that the IRS or Congress has not closed the loophole, so to speak, on Roth by now, just because.
Be careful.
Exactly.
Don't say that too loudly.
I kind of did not expect it to last this long, but Roth can be a very good thing. However, it is important to consider your current tax bracket when deciding whether to fund a Roth or a traditional IRA. If you make enough money to where you're likely going to have less income in retirement, it may not make sense to fund a Roth and give up the initial tax benefit, but that's something we can talk about if you come in for your complimentary consultation.
So I think that's one that most people know about is the Roth IRA. The next one is financial gifts if you receive them. Now, is there a limit on that? Let's say I get $10,000 versus $100,000. Is there a limit on the taxation on that for financial gifts?
Yeah, Jeff. So I think when it comes to gifts, there's a lot of confusion out there because of the exemption for gift tax reporting. And so there's a lot of people that are like, hey, if I give less than a certain amount a year, $14,000 a year, then I don't pay any taxes. The reality is you don't pay taxes if you give away $1 million in today's world. But it does go against your gift tax exclusion, and that's an important difference. So getting a gift is not taxable under current law, unless it's over a certain threshold, which is in the $11 million range in today's world. Now, again, I think Congress is going to act to change that. But if you give somebody $100,000, it is not taxable to them in the moment, but it does go against your gift tax exclusion if you give it away.
So for the receiver, there's no tax, but for the giver, there's a limit, isn't there?
Yeah, Jeff. So if we do less than $18,000 per person per year, you don't have to report that gift. But if you do over that, you have to report it. But there's still no taxes when that gift is given away. It only goes against the tax exclusion if we're over $18,000.
We're talking about things the IRS does not tax. We've talked about Roth IRA income, financial gifts, inheritances in most states are not taxed. What about the state of Missouri?
Yeah, and so the gift tax and the inheritance tax are kind of the same thing as far as inheritance tax is basically like a gift. And so it's not going to be taxable, again, with the exclusion of that's currently $11 million. If you have a trust in a couple, it's $22 million. But anything under that is not taxable at this point. However, again, Congress is expected to allow those taxes to expire, and then we go back down to the $3 or $4 million range, and then we'll kind of see where it goes from there. But yeah, inheritance is also not taxable in most cases in most states.
And next was life insurance proceeds. I think most people realize that life insurance proceeds are not taxed. Is there any instance that you can think of where there is tax on such a thing?
Yeah, so the actual proceeds from life insurance are never taxable. However, depending on what you use the life insurance for, and again, this could get really in the weeds here, but how you fund a life insurance policy, there's something called a MEC, or a modified endowment contract. If we stuff too much money into a life insurance product above a certain threshold, then the loans can be taxable and things like that, versus they are not under current scenarios. But when we're talking about proceeds from actual death benefit of life insurance, they're not taxable.
Next one on the list here is going to be disability benefits. I understand that the cost is being disabled, but as far as taxation goes, there is no taxation on disability benefits.
Right. And so I think that's fair, although to your point, I'm not ready to get disabled just so I can have the tax benefit.
Right.
But yes, it is a nice thing that they are not taxable. Again, they are not designed to be taxable because that money's already coming out due to the disability, so it doesn't make sense to tax it and reduce it after that.
And some of our listeners may be in the age group where they may have served in the military. They may have served in Vietnam, for an example, and they used Agent Orange there, so they may get disability benefits as a result of that. And I understand that those are not taxable. Do you have clients who receive that sort of disability from the military?
Yeah, I do. I have quite a few clients that have various disabilities, either hearing or vision, or like you said, from the Agent Orange, things like that. But yeah, those benefits are all not taxable.
So life insurance proceeds not taxable. Annuity growth is the next one, not distributions. Growth versus distributions on annuities.
Yeah, Jeff, I think any growth that we take on annuities is tax deferred, not taxable, right? So that means that when we have an annuity and it grows tax deferred, kind of like an IRA, where we don't pay any taxes until we take the money out. So the growth can be tax deferred almost indefinitely, and you can even do some very creative things with passing that money to your beneficiaries, where you can do a post-death 1035 exchange and continue to kick the can down the road on taxes. Again, I wouldn't say that that's, not taxable. That's a little bit different category, but I would say that it is tax deferred until you take distributions.
Next one is long-term care insurance distributions. Now, we talk about long-term care policies on this program every once in a while. Most of the time, it doesn't work for a lot of people, but for those people who do have an LTC policy and manage to make that pay off, is that income taxable?
Yeah, it is not taxable under most circumstances, and that's one of the benefits of the long-term care insurance is that, it's an insurance payout similar to a life insurance payout. It is not taxable, and so obviously that money goes a lot further than if it were taxable and you were stacking it on top of your other income.
And the next one is municipal bond interest as far as taxation goes. Is that taxable or not?
So it is federally not taxable.
Okay.
If you have a municipal bond that is local in your state, it can be state tax exempt as well. However, I will say that there's quite a few people that really over-glorify municipal bonds because of their tax exempt status. Most people that are in a 10 or 12% tax bracket, especially the last 15 years or so when municipal bonds were just paying awful interest rates, it makes no sense to put money into a municipal bond to get tax exempt interest at 2% if you could go buy other bonds that pay 4%. right? Because the math simply doesn't work unless you're in a gigantic tax bracket. So it is tax exempt, but I find that there's a lot of people that use municipal bonds in a way that really doesn't make sense given their tax bracket.
We're talking about income sources the IRS does not tax with Jake Floyd of Floyd Financial Group. Last one here is capital gains. Normally, they are taxed, right?
Yeah, so there are basically three different tax brackets at the federal level for capital gains, and up to a certain threshold, you don't pay anything on capital gains. So let's say you make $50,000 a year if you're filing as a couple, and you have a $30,000 capital gain, long-term capital gain, you would pay no capital gains tax on that for the federal tax. And so that can be a tool where we can liquidate things over a period, depending on what the asset is, where we can do it over several years and not pay taxes. Then there's a higher bracket where from basically $94,000 adjusted gross to $583,000, you pay 15%, and then over that threshold, you pay 20%. And so it's important to understand what that's going to do to your other income and what it's going to do to your capital gains. You need to make sure that we're also distinguishing between short-term capital gains and long-term capital gains, because short-term capital gains are taxed at ordinary income levels versus long-term capital gains have a special tax rate that we've been talking about here.
Jake, for most people, their home increases in value if they sell it and they realize a gain, let's say, of $200,000. Is that taxable?
Under most circumstances, no. You have a $500,000 exclusion.
Okay.
However, there are some strings attached to that. You have to have been there the last 2 years, and that has to be your primary residence and some other things. But basically, the answer is no, that would not be taxable up to $500,000 worth of gain.
With other real estate, let's say investment real estate, you bought that for, let's say, $35,000. It's now worth $400,000 and you sell that. Is that gain normally taxable?
Yes, so if it is not your primary residence, that will be a taxable gain when you sell it. However, this is one thing that a lot of people get into, depending on your age and what you want to have happen with that money and that property. You could 1031 exchange to another property and not pay the taxes. But if you sell it, you would pay the capital gains rate. However, if you pass it as a result of your death, you would get what's called a step up in basis, meaning the person who inherits that money would potentially receive a step up in basis to the value at the date of death, meaning if it's now worth $400,000, their basis will become $400,000 upon your passing it to them at death. So those are all considerations and things we want to look at before we do something like that.
Jake, if our listeners have questions about things that are taxable and not taxable, I would suggest that they call us and get their no cost, no obligation, no judgment Floyd Financial Group Retirement Review. Very simple to get. It's not going to cost you a dime. Call 417-889-7233, 417-889-7233. If you call this weekend, simply leave your name, your telephone number. Ashley will give you a call back on Monday. Find a convenient time for you to sit down with Randy and or Jake there at Floyd Financial Group. Talk about your journey towards retirement. And remember, it's not going to cost you a dime. There is no judgment. It is a no-tie zone. It's simply just an opportunity for you to have a very simple conversation, to ask the questions that you need to make intelligent decisions, to make sure that you don't run out of money in retirement and you have the sort of retirement that you've always dreamt of. Once again, not going to cost you anything. 417-889-7233. You can also request your plan online at FloydFinancialGroup.com. Time for a break, Jake. We'll be right back with more of Show Me the Money right here on 104.1 KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about traditional IRA basics and some things that you should know.
And Jake, a traditional IRA can be a really powerful retirement savings tool, but you need to understand contribution limits, RMD, rules for beneficiaries under the Secure Act, and a lot more. So let's talk about some of the IRA basics here, 10 things that you need to know. The first one is saving tax-deferred can boost your nest egg.
Yeah, I think this is something that a lot of people don't quite understand. People come in and they say, hey, should I do a traditional IRA or a Roth IRA? A lot of people just see that the Roth is tax-free after a certain point. But if you fund a traditional IRA, that should allow you to fund more because it's tax-deferred, right? So you get a tax benefit from funding it. So you're not paying as much in taxes, so that should allow you to fund more. And that's one of the proponents of this. Like you said, saving tax-deferred can boost your nest egg by allowing you to save more than you would be able to save otherwise.
So that's the difference between a traditional IRA and a Roth IRA?
Yeah, the main difference is tax benefit now versus tax benefit later. Certainly if you're into the 22% federal tax bracket, there's a lot of people where it makes sense to go ahead and fund the traditional IRA. Again, there's no blanket advice to say, hey, you should do traditional or Roth, but that's definitely something we think a lot about when we're meeting with people that are, 10 or 15 years out from retirement as far as which type of contribution we should have and how much. Sometimes it makes sense to blend the two to make sure we get just enough tax benefit to keep us out of the next tax bracket or something like that.
But we are talking about traditional IRA basics right now. The next one is that there are IRA contribution limits, right?
Yeah, if you're a married couple, it's important to realize that you can do $7,000 or $8,000 respectively for each person as well, not just for one of you.
We're talking IRA basics with Jake Floyd at Floyd Financial Group. The next one, Jake, is non-working spouses. They can get their own IRAs.
Yeah, in certain circumstances, you do not have to have the actual earned income if you're a stay-at-home spouse to be able to fund your IRA. So that's a nice benefit that they give. That way, it's not all one-sided when it comes to retirement for one spouse or the other, just because they decide to sacrifice their career to make sure their kids, are in the best possible place. Or maybe you operate a farm at home that's not really a farm that you're trying to make money on, but one that just provides what you need, vegetables, maybe a few cattle, that kind of thing. I think that's really extra important in today's world because public school is not exactly what it used to be, in my opinion.
No.
And I think there's a lot of people that are opting to keep their kids at home for a lot of obvious reasons that I probably don't need to name going down here. But I think that those people should not be penalized for taking care of their kids, which should be their number one priority.
Jake, a lot of tax deadlines fall at the end of the calendar year, but is there an exception for IRAs?
Yeah, so there's a few interesting things that happen with IRA contributions. From January 1st to April 15th, you can actually contribute for either the previous year or the current year until April 15th. So that's an interesting benefit where if you didn't contribute the previous year, it's good to fulfill whatever you can from the previous year, so that gives you the most options in the current year. Or you could theoretically fund both between January and April 15th if you wanted to. So there's some flexibility there.
Jake, most people, when they were working for someone else, they were offered a 401k. My question is, can you have a 401k still and then open an IRA? Can you have both, basically?
Yes, you can. However, depending on how much money you make, there are some stipulations there, and I don't want to get too far into the weeds there, but if that's something you're wanting to do, really tax defer extra income or really max out 401k and IRA, that's something we should talk about before we get too far down that road, but it is possible.
Jake, if someone does still have a 401k or several 401ks from a previous employer, when does it make sense to convert that to an IRA, and does it always make sense to convert to an IRA?
I wouldn't say that it always makes sense. There are a few exceptions there. I do think by and large it makes sense to convert to an IRA so that you have more investment options versus just a handful of mutual funds that your plan allows for. However, there are some reasons to not do that. If you're a federal employee, a certain type of federal employee, you can have exemptions all the way back down to age 50 in a TSP account where you can take distributions before 59 and a half and not pay the 10% penalty on there. If you want to loan money out against an IRA, it's much more difficult to loan against an IRA than it is against a 401k. And loaning against your 401k is much more beneficial as you pay interest back because you kind of get credit for that. You're not paying it to some third party who's charging you interest. So there are reasons to keep it in a 401k or a portion of it in a 401k. But by and large, it makes sense to roll it out and be able to have more investment options at your disposal.
We're talking about 10 IRA basics with Jake Floyd here at Floyd Financial Group. The next one, Jake, is you can make non-deductible contributions to an IRA.
You can. I'm not sure that makes sense to do, but you definitely can. Most people are making contributions to an IRA specifically because you want the tax deduction, or to a 401k, traditional 401k. In this particular case, you can make non-deductible contributions. However, you have to keep track of that. And it may make sense just to simply fund a different account if you're wanting to do that, rather than trying to lump it all in together inside the IRA.
If you do have a 401k, you can roll it, of course, into an IRA, a traditional IRA. But what happens there as far as the taxation goes if you do that?
Jeff, when you choose to retire or change jobs, you have the option to roll that money out. If you take that directly through your bank account, you have 60 days to roll that money out. However, a lot of times the employer is going to withhold 20% for taxes, which really screws everything up. So usually the best way to do it is to do a direct rollover to whoever the new custodian is going to be. For example, our custodian here is Charles Schwab, and so if you wanted to roll over a 401k, we could move it over to Charles Schwab, and they cut the check to Charles Schwab. That way, you don't have to actually put it into your bank account and wait for it to clear, and they don't hold extra taxes out. They just send you 100% of the check.
IRA Basics, that's our subject here with Jake Floyd of Floyd Financial Group. Jake, can you make early withdrawals from an IRA?
You can absolutely make early withdrawals from an IRA. However, we're going to be hit with a 10% penalty in most cases if we do that. And so there could be a reason to leave some money in a 401k if you think you're going to need some money. If you leave it inside a 401k or roll it into a new 401k plan at a new employer, you could potentially be able to loan on that money and get that money out without paying the tax or the 10% penalty in that situation. So that's definitely something to consider before rolling all the money into an IRA and kind of getting rid of that potential benefit.
And don't forget about RMDs, required minimum distributions, Jake.
Yep, the dreaded RMD. So I get a lot of questions about RMDs, and I think RMDs by and large don't affect most people because they're already taking out more than enough income to satisfy their RMD. However, the rules obviously have changed quite a few times over the last 4 or 5 years. It used to be that you'd have to be 70 and a half before you have to take your first RMD, and then the Secure Act changed it to 72. The Secure Act 2.0 changed it from a range of 73 to 75, and so what age you have to be to take RMDs. Right now, a lot of the people that are asking that question, they'll have to be 73 in order to be forced to take an RMD. However, in that first year, it's a fairly minimal amount, roughly 4%. So if you're already taking out 5% to live on, you don't have to worry about the RMD. That's one of the things that we do here is keep track of everybody's RMD, make sure they're taking it so that the individual person doesn't have to worry about it.
Okay, so if you're a Floyd Financial Group client, you remind people to take their RMDs. But if somebody listening to us is not a client yet and they forget to take their RMDs, Jake, I understand that there's a pretty substantial penalty for that.
Yeah, so it used to be that it was 50% of the amount you didn't take, but that is actually going to 25% now, which is kind of interesting. But I think some of that comes in here with our last point, and the reasoning for making that penalty less steep is because some of the rules they're changing about your IRA beneficiaries and how they have to take money out is also changing. It used to be that you could pass money on to your children or grandchildren. You could do something called a stretch IRA, and it would allow you to take it out over their lifetime. And so the Secure Act changed that to where you have to take it out over 10 years. Most attorneys and tax professionals interpreted the rule that the IRS put out that said, hey, we just have to have it all out at the end of 10 years. So you can take it out 10% a year. You could take it out, a little bit at a time and then a big chunk at the end, or however you wanted to do it. Now the IRS is coming back and clarifying, saying, hey, we meant that we want you to take the RMDs for the 10 years and then make sure it's all out at the end of the 10 years. And I think part of the reason that they are softening the RMD missed penalty from 50 to 25% is because of the way they're changing this rule.
Jake, is there any mercy on this rule? Let's say that it's little old Aunt Gladys and maybe she has a little bit of cognitive decline. She's forgotten to take her RMDs. I mean, is there any way that the IRS shows some mercy on people like that as far as these RMDs go?
I wouldn't say there's any mercy, Jeff. However, I do think that happens fairly often because I have people that say, hey, I haven't taken XYZ numbers of RMDs. Again, that's not necessarily a good thing. I will say that if you have missed it, I would go ahead and take the RMD. Right. And there's a special form that you can file to kind of say, hey, I'm sorry, my bad. There's no guarantee that they will be lenient, but it's still a good idea to take it anyway. That way, if they catch it later, they don't look at you and say, hey, you haven't been doing this. Here's your penalty.
Right. And what I'm reading here is that you could request a waiver with a letter of explanation, as Jake says, when you filed your Form 5329. So, again, as Jake said, there is no guarantee that there's going to be any mercy on that, but at least give it a try. We've been talking about IRA basics with Jake Floyd of Floyd Financial Group. Once again, if you have questions about IRA basics, maybe you've got a 401k, you're looking to transfer that to an IRA, do a rollover. Should I stay with a 401k? I know you've got questions. questions, Jake and Randy have answers at Floyd Financial Group. Once again, for the loyal listeners to this radio program, we're not going to charge you a dime for this conversation about these topics. Once again, to get your no-cost, no-obligation, complimentary retirement review with Randy and Jake at Floyd Financial Group, call 417-889-7233. 417-889-7233. You can also request your complimentary consultation online at floydfinancialgroup.com. That is floydfinancialgroup.com. We're glad you could join us here for Show Me the Money with Jake and Randy Floyd at Floyd Financial Group. If you've missed any part of the show today, remember we're also a podcast. Simply go to wherever you get your podcast, search for Show Me the Money with Randy and Jake. You'll find this show and many of our past shows so that you can stay on top of your journey towards a confident retirement. We're going to take a break, Jake. When we come back, we've got the final portion of our show. We're going to be talking about the de-dollarization of America. Is that going to happen? All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this last segment, we're going to be talking about de-dollarization. What does that mean? And what is BRICS and CBDCs and all that madness?
Yeah, I've got a lot of questions about de-dollarization, Jake. And the first one is, what is de-dollarization? Does that mean that we're not using the dollar anymore? Does it mean that we don't have cash in our wallets? What does it exactly mean?
So I think de-dollarization at its core really focuses around using the dollar as the world's reserve currency, which has been happening for a long time now. The United States dollar was not always the reserve currency of the world, but it is now. And what that means for those who are not aware is that any commodities out there that are bought and sold around the world, you must go get dollars in order to purchase them. So let's say that France wants to buy some oil from Britain. They have to go get dollars to make that purchase. Everything is priced in dollars. And that affords us a lot of luxuries in this country that a lot of people may not be aware of, but it gives us a lot of economic power. And so when that begins to get threatened, as it has been under the Biden administration, people start asking questions. And so you may have heard of BRICS, right? So BRICS is Brazil, Russia, India, China, South Africa, right? It's an acronym for those countries. And those countries have kind of banded together to start to try to overthrow the dollar in world trade. This is very concerning because, again, we have enjoyed a lot of preferential treatment due to the dollar, but it should also be concerning to other countries where if we start using a different currency that can be manipulated by other countries, such as the Chinese yuan, right, that could really be a problem because China will not hesitate to throw everybody else under the bus to benefit themselves. And so we need to be very careful who we allow to have that power. And I think people are rightly concerned about this issue.
So it appears that America is sort of the dog here, and the dog is wagging the financial tail in terms of the dollar being the standard of currency here. You have people who ask you all the time, and they're really worried about the de-dollarization of America, Jake. Why would that be of concern to the layman listener listening to our program today?
You may have heard about all this money printing that's been going on, quantitative easing and the like. After the financial crisis into COVID and all that, we've printed $8 to $9 trillion over that period. And when we print money, because everything's denominated in the dollar, really affects everybody else more than it affects us. Other countries view us as abusing that power, and that's why some of them want to try to take it away. It was also probably a mistake to try to weaponize that against Russia in the Ukraine war by forcing Russia to not be able to use dollars to trade on the SWIFT system and other things. Arguably, I think that could have been a mistake because it forces other countries who still want to do business with Russia to go around the dollar to do it. And that's really what started prompting a lot of the de-dollarization around the world. There's a lot of other countries that would love to have this power to hold hostage the rest of the world, namely Russia and China would be the two top ones among that list, but maybe some other ones that seem less nefarious, such as Brazil or South Africa, that would like to also get their hands into the till. But I really think that, as most people probably agree on this show, listening to this show, that a strong America is good for the world, and that probably starts with the dollar. And the economic power is probably more important than military power in today's world.
In the beginning of the show, Jake, when we were talking about the de-dollarization of America, you mentioned BRICS, but you also mentioned CBDCs. What are those?
Yeah, central bank digital currencies is what that stands for. And what a lot of people are concerned about is that the Fed or other central banks around the world will roll out a currency that is digitally based. And so it's based on blockchain to where they would be able to shut off purchases that they didn't like. So, for example, a lot of people may not know this, but for a while in New York City, it was illegal to buy a soda larger than 32 ounces because it's bad for your health.
Didn't know that.
And while maybe we should agree or not agree on that one, that's a very dangerous thing to do, to start outlawing things that you think are unhealthy, right? As we go down that road, where do you draw the line? Too much red meat. Pretty soon we're all eating crickets, right? So I think that's a dangerous thing to do, and I think people are rightly concerned about if we were to have a central bank digital currency that kind of takes over the dollar or is a version of the dollar, that would be a problem. However, in my opinion, this is where I differ from a lot of other people. I don't think we're that close to that takeover. I do think that probably comes eventually. But I think it's probably closer to 2 decades than 2 years away. I've had people come in and say, hey, this is going to happen in a couple of weeks. I just don't see the infrastructure in place that would be necessary to make that change anytime soon. And so, again, I'm not saying those people are wrong. I'm just simply saying that I personally don't believe that that's going to happen in the real near future here, the way a lot of the Glenn Becks and some of the other scaremongers of the world have been saying. Frankly, they've been saying it's going to happen in a couple of months for a couple of years now. And so I think we need a little accountability on some of these people.
Yeah, that's interesting that the de-dollarization is going to happen in a couple of months. I mean, I wonder where they get their facts on that. It hasn't happened yet. I don't expect it, as you said, to happen for at least 20 years. So it's not anything that most people listening to us really need to worry about. When you talked about de-dollarization, when we talked about that we were going to even use this as a topic, I was thinking about the D-dollars or the lack of dollars in my wallet these days. I'm finding more and more people, retailers and vendors and so forth, who do not take cash anymore. Are you seeing that is very prevalent these days?
Yeah, and I think that's actually where a lot of people's fear comes from. There's a lot of places that don't even take cash, so it'd be very easy to have the government step in and say, hey, all right, you can't buy any more guns now. Firearm purchases are now outlawed, right? And again, I think that's a legitimate concern. I just don't think the infrastructure is there. But yes, I do think that should be a concern. All that to say, though, that the dollar, for example, is represented. If you have a $100 bill in your hand, it's representative of a number on a screen somewhere, not the other way around. I think a lot of people look at their cash and it says, hey, this note, as it used to be, was representative of a certain amount of gold somewhere, right? It's not backed by anything anymore.
Right.
So really your dollar is representative of some digital number somewhere. And while that may be shocking and scary to a lot of people, it's been that way for quite a while. Gold has value because we've decided that it does. There's nothing inherent in gold that makes it valuable. Same thing for Bitcoin, as we talked about earlier. So I don't think the dollar, Bitcoin, or gold itself, there's really a lot of difference between those three things, although I think a lot of people listening to this might disagree with that. It's all digital already. And so what we need to be focused on is not allowing politicians to take away our ability to purchase things that they just don't like for some reason. And so I think that's why people are really concerned about CBDCs, and rightfully so. But again, I don't think it's just right around the corner. And if we get some different people elected, we'll just say that I think that could go a long way to ensuring that does not happen sooner rather than later.
And personally, Jake, I look in my wallet right now. I do not have any currency in my wallet whatsoever, which is a little inconvenient if you're in a situation where you want to tip somebody, like the guys that delivered my washer and dryer yesterday. Would have been nice to be able to give them a tip, but I'm not carrying any money. And in my observation in things like fast food restaurants and the supermarket and so forth, very few people are paying with currency these days. Do you think that can be a problem sooner than later?
I don't think it's a huge issue that we're using credit cards and things like that. I'm in the same boat, Jeff. I don't usually have cash on me. I usually try to keep a little bit of cash in my car, a few bucks, just in case something were to go wrong and the card wouldn't work or whatever, and I could get a little bit of food or gas or something like that. But I do think people should probably brace for a paper currency-less world. It's going to be plastic at some point. And it helps everybody track everything better, but the downside is it helps everybody track everything better. And so, depending on who the leadership is really the problem more than the means, in my opinion. Again, back to the CBDCs and the disallowing of certain types of purchases. I think it's very important that we have some kind of legislation soon to prevent that from happening, or prevent the building blocks from being laid on that to where it becomes irreversible and inevitable, if you will. Because I think as long as we live in America, I don't think that the government should have that much power over us.
And you talked about who sets the value of gold. And for me, it's Bill Devane, who's on TV saying, hey, gold is worth all of this money and you should put gold in your portfolio. I mean, what do you think about that? I mean, I know this is a little off topic, but I mean, there are all these things saying, listen, you got to have gold in your IRA. What's your opinion on that?
Yeah, so I think a lot of people want to buy gold because they feel like it will be the currency of the apocalypse, right? If everything goes to heck in a handcart, as my dad would say, I have this gold that I could use to buy things. I think personally, and again, this doesn't make me right, but personally, I don't think that's a very viable way to use gold. I think after a couple of weeks of that scenario, gold will not be worth very much, if anything. However, I think it's okay and maybe even prudent to have a little bit of gold or silver. I think silver will be easier to pay for things simply because of its value. We don't have to scrape off a few shavings of gold, to buy gas or whatever.
Yeah.
I personally am not a huge fan of having a bunch of physical gold, mainly because the transaction cost of buying it and selling it is very prohibitive. So in the investment world, a 1% transaction cost in and out of a stock or something like that would be usurious in today's world. And in the gold world, 10% is not usurious. Meaning if you want to go buy $1,000 worth of gold, you're likely going to pay $1,100, $1,150 for that $1,000 worth of gold. And so if you just make one round trip, you got to have gold go up 20, 25% just to pay for your commission. And so that's my biggest issue with gold for people in retirement is if you're going to buy it and hold it and there's a certain amount, fine. But you certainly don't want to have to be living out of that gold and making transactions all the time in order to make ends meet. It's not a very good way to get retirement income, in my opinion.
We're talking about the de-dollarization of America with Jake Floyd of Floyd Financial Group. Once again, if you're interested in our conversation today, you'll want to have a conversation with Jake and Randy there at Floyd Financial Group to ask your questions about de-dollarization or anything else that's on your mind as far as retirement goes. We're offering a no-cost, no-obligation retirement review. To get yours, call 417-889-7233. Again, not going to cost you a dime. No obligation and no judgment. 417-889-7233. You can also request it online at floydfinancialgroup.com. Jake, out of time for this week. I want to thank you for your time, but of course, most of all, I want to thank our great listeners for joining us. For Jake Floyd, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week with another edition of Show Me the Money right here on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and are not intended as investment advice for any individual or entity. All information contained herein believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning offered through Floyd Financial Group, LLC, an investment advisor registered in the state of Missouri.